Now, before we go into Asia, we'd like to remind you, please like, share, subscribe. Your support is always appreciated. Now, before we get fully away from the euro and South Korea, or I should say euro into Asia, we really want to talk about Eurostat PPI and South Korean PPI, because when you look at the two, they're fairly tightly correlated. And that's something that has continued to happen over time. When you look at how Asia in general has ingrained itself more within Europe, within the US as well, where PPIs are going to continue to move up. And it's really coming down to when you look at the euro and where they source a lot of their semi-finished goods, and raw materials, or at least inputs into a final product. South Korea and Asia become are a much bigger part of that pie, which again is keeping those prices continuing to be elevated, and they're moving up in lockstep. And South Korea has been a fairly big leading indicator, which just shows that there's going to be a continuous pull higher, even in Europe, which is again just a bigger input or an important input into pricing and to that underlying inflation calculation. So when you look at ASEAN growth outlooks, we have to look at what are some of the forecasts. So when we look at 2020, obviously those are the pressure. But then when we look at 2021, that's where we start to see some of this breakdown in terms of, it's going to be growth it's very clear. But what is that growth going to look like? We still think Vietnam is going to be strong. Malaysia, Singapore have been facing some of their own lockdowns. They've faced some COVID issues that we think is going to pull back some of those 2021 forecasts. And then when you look at Thailand, something similar, Indonesia, these are things where COVID has become a much bigger problem for some of these areas, especially the Delta variant or the Indian variant, which is limiting some of that next level movement in terms of just growth. But they're still going to grow. It's, year over year, easier comps. There's still stimulus out there, where the US and Europe as well are trying to move our supply chains out of China, which will be supportive, especially on the longer term thread. But it does mean that we could see some of these 2021 misses, especially as inflation drives higher, the consumer struggles, and some of these countries also rely on tourists, and we know that international travel is not coming back anytime soon from either China, the US, or Europe, which is also going to be some of those impacts. Then when we look at some of those credit impulses that we've always talked about, credit impulses within China and then the global manufacturing PMI new export orders, this is where we continue to see China credit impulses moving down again, and they've continued to shift down. There was a small pause in M2 expansion, but credit impulses continue to be how China's trying to adjust their $12 trillion debt market to try to tighten things back up as problems continue to arise and become a much bigger issue, which is going to pull down some of this global manufacturing PMI, especially on the new export order side, which is why we think these PMIs have started to peak and are going to start to come lower as we see some of this pressure, because you can see it's a fairly decent leading indicator. Now, China, we've seen more divergence. We've seen individuals and countries moving and trying to diversify supply chains away from China, but there's still such a huge part of the global supply chain construct that it's really hard to see this not being a better indicator as pressure remains within China. And then on the Japanese side, you can see PMIs are rolling over. Now, when you look at where we sit on services, they missed estimates coming in at 47.2. Composite came in at 47.8. Manufacturing also rolled over, but still a slightly expansionary 51.5. But you can see that we're still in contraction. With one of the largest countries in the world, and we're still facing these overhangs that remain an underlying problem. Now they're starting to wake up from COVID, starting to reduce some of the emergency the emergency lockdowns and state of emergency. That's the word I'm looking for. But they do have the Olympics coming. Hopefully you get some driver. But really, this is where we continue to see some of these problems, where the Japanese continue to struggle having some of these overhangs. Now, on the other side, when we go internally, Japanese department store sales continue to be fairly weak. moving in the wrong direction. So not only is there a PMI problem, but there is a local consumer issue that continues to be an overhang in not just Japan, but also China. The local consumer is just not active and is just continuing to become or remain an overhang instead of a driver for economic growth and just for local consumption in terms of local manufacturing and some of that populist driving. Now, when you look at marginal propensity to spend indicator, continues to get weaker for households and non-financial enterprises. This continues to drive home the fact that the local consumer is just not doing anything, even though they were incentivized to do so in May, which was deemed the month of spending. With all of these incentives, the local consumer or households in general, is still weak, is still not adhering to the dual circulation strategy, and remains that overhang within the Chinese economy, which we continue to talk about, we continue to drive home. The market so far doesn't really care all that much, though the Chinese market has, their indices have slowed a bit, but they're still bumping along this support. But there still is this overarching problem. We've seen it with oil consumption, with imports. They're trying to restructure, cutting import quotas for teapots by 35%. All of these are red flags for what activity really looks like within Asia, specifically China, which is the second largest country in the world, especially on an economic side. So then when we look at retail sales in different volumes, emerging Asia has gotten better, but that has started to abate as well, because when you look at where this is striking, when you look at just where things were, and especially when you set it to December 2019, some of these slowdowns have accelerated because of lockdowns, but those are going to be temporary. We're going to see some of that come back. Latin America is starting to wake back up, but emerging Europe has started to come under pressure, and it's really the inflation side. So when you look at Europe, especially emerging Europe, they've been facing a lot of inflationary issues, and those are starting to awaken in emerging Asia as well. Now, that's why we think that you're going to see some of this rollover, especially when you start talking about China and start factoring in the pressures that we're seeing, because a lot of these countries rely on components from China. China may be the end consumer, or at least a big part of their manufacturing, and all of that inflation is continuing to drive higher, especially when we break it down on factories to households inflation in China. So when we look at this, when you look at just where some of these areas are on hotter versus colder, most of these things are running on the very hot to moderately hot side of things in terms of where these inflation drivers are going. Iron ore, copper, coking coal, especially coking coal, which is continuing to go up, crude, the Baltic Dry Index. Look at how quickly the Baltic side continues to move higher. Iron ore at ports, rebar, copper, gasoline, and especially gasoline. Just look at where those prices are and how it's going to impact the consumer, because these are big inputs for them, which is going to be that overarching impact to how freely are they going to consume and purchase and buy in general. So again, these are things that we continue to see as being an overall problem in general. Now, let's look at this a little bit differently. So officially, the Western region includes 12 provinces, which together account for over 70% of China's geographical area, but only around a fifth of its economic output. Guangdong, Guangzhou, these are areas that have a massive amount of manufacturing, which continue to be under some sort of COVID restriction, issues with electricity. These are some of those impacts that we continue to see moving out and broadening and causing some of these economic slowdowns. But because of those issues, it's also creating these expansive supply chain problems that are continuing to drive up pricing. Now, the push to develop this region was initiated back in 1999. On Friday, Premier Li presided over the routine State Council executive meeting. Top of the agenda is pushing financial institutions to cut fees to borrowers. Why are they doing that? Because companies continue to struggle. Small businesses are still in dire straits following the economic fallout of the pandemic. Continued weak consumption, as we've been talking about, and sky-high upstream commodity prices, hello, inflation based on this chart, are only exacerbating the problem. To help businesses, Lee called on financial institutions to cut different fees, withdrawal fees for payment accounts of small and micro-sized businesses, service charges for online payment by 10%, fees on bank card transactions, interbank transfer fees for small and micro-sized enterprises, fees for ATM interbank cash withdrawals. The fact that Lee and company are calling for continued cost and fee cuts for small businesses is a sign that top officials are still worried about the economy. Fee cuts won't address the larger issues of inflation and battered consumer confidence. All of those things are apparent in all of these data sets, which again lead to why we continue to be cautious about Chinese growth, and therefore, based on Chinese growth, global economic growth, and underlying Asian growth as well. So then when we look at South Korea exports, imports, they still remain very strong. Now, remember, a lot of things have shifted out of China, and South Korea has been a beneficiary of that. And if you look at just imports still remain elevated. As we said last month, we saw a dip in imports, which was going to lead to a dip in exports. But things are just starting to normalize, and imports still remain elevated. Exports will remain strong, especially given their importance to the technological supply chain in terms of chips, computers, and just inherent technological stuff and appliances. Even though some of those have slowed and prices have gone up, they still remain a key driver for a lot of that flow. Now, when we look at just where some of this industrial production is on the U.S. side versus China, so industrial production, Euro area versus U.S., and China M1. So typically when you look at Chinese growth, N1 to N2 minus N2 growth, when you see this expansion, so China is stimulating the economy, you can see a lot of industrial production in the Euro area and U.S. picking up. Now we have this big pickup, but we have this big drop in where that growth is really going to come from. And this is becoming, I think, a broader problem, because when you look at the stimulus they did from the end of 16 all the way through 18, that's where you saw this big pickup in industrial production. And it's just going to become an economic slowdown in China is a risk to European industrial activity. And I think that is where, again, additional fears for us come for where does Europe go from here, just given where some of these overhangs are, especially when we talk about China, which is why we talked about that Chinese debt in segment 4, because as you see their cost of borrowing, especially on, and we'll talk about some of the investment grade debt in the end of the segment, but even in high yield, there's continues to be some of these overhangs. Now, when you think about what has happened so far, just because it is the 100th anniversary of the Chinese Communist Party, the party history, according to Xi, which means glossing over the party's failings. So what do we have? So the Wall Street Journal said, past editions of A Short History of the Chinese Communist Party, an authoritative text for general audiences, devoted hefty passages to Mao's Great Leap Forward. The revised version, published in February, excises the earlier edition's conclusion about the programs and its fallout. This bitter historical lesson shouldn't be forgotten. The new version also dropped detailed discussions of Mao's mistakes in launching the Cultural Revolution, a series of purges against counter-revolutionary elements that ravaged Chinese societies and left as many as millions of people dead. Instead, it focuses mainly on China's industrial, technological, and diplomatic achievements during that decade. It also means glorifying Xi. Chapters were added that describe Mr. Xi as a visionary statesman whose authority as the party's core leader must be upheld. Amid 10,000 majestic mountains, there must be a main peak, reads the updated book, which devotes more than 1/4 of its 531 pages to Mr. Xi's policies and achievements. So they're taking away everything bad that had happened and things that could have been learned from it, and are just focusing on, and again, this is the drive to trying to get people to buy into and believe in the CCP, trying to drive this home as their policies continue to struggle, especially on the consumption side, and this investment, which is as they continue to try to tighten up, economic slowdowns are coming. And they're trying to wash some of this out and show on how great they've done over this period, and ignoring some of the failings, because right now they're at risk of repeating a lot of them. Let's put it that way. So then when we look at M1 in terms of advanced 6 months, here's where we're looking at official M1 and where things sit in general as we go forward. So here you can see that this rollover. So when you look at M1 in dollar terms coming down, advanced 6 months as things pull down, dotted lines on just the underlying forecast continue to push forward, which is why, again, these slowdowns continue to be apparent when you look at this on different levels, trying to understand where commodities sit, where this without investment, without this expansionary movement, this is why a lot of these commodity indexes have really run ahead of where they should be at this moment, even though inflation, and it's not that they have to collapse, because this is where we're going to talk about in a second. They don't have to collapse back down. It's just stop going up. You're going to see this pause, and that pause, again, leading more to that stagflation side. Now, credit growth has decelerated to its trough reach in 2017-18 and tightening cycle, because remember, they had a big stimulus in 16 through 17, started to cut it into 18. And then you can see that we're back to those levels, and the annual change of adjusted total social financing as a percent of GDP. Now, again, we talked about how the consumer is slowing below GDP estimates or targets. You have industrial production below targets. You have industrial investment below targets. Now you have social financing continuing to fall. These are all the things that are going to lead to China, because remember, they said at least 6% GDP growth. Many people on the street have 8.5% growth, and these are the things that are going to continue to weigh on them, as well as commodity consumption, crude consumption, because we've already seen that pressure on just how much oil they're importing and what that demand really looks like. So then when we look at the overall, the backdrop of some of these, the indices, when we talk about debt, because we've seen the high yield debt continue to move wider, people are getting more concerned, and it's all stemming, or a large part of it stems from the concerns in these eligible corporate bonds. Some of them were investment grade, some of them were double or triple, or I should say more double A. But Yurong, Evergrande, all of these, which only comprise 6%, but are calling out how bad are the off-balance sheet risk? How much debt do we have to be concerned about? Is there enough capacity to back this debt? Because so far with Yurong, they're going to sell about, they have 7 different tranches that they want to sell, and so far those tranches won't back or won't be enough money to cover just the principal of the bond. So again, a lot of these bonds are coming out more and more underwater, which is creating an underlying problem for the PBOC and the CCP, because it's increasing the cost of debt, it's pushing up interest rates, and you're seeing it on the high yield side as well as the more investment grade side. And it's just going to show you, because it's across a broad swath of areas, because when you look at government bonds, financial bonds, corporate bonds, all of these levels continue to move up. Now, central bank bills are important because you have the ability to convert perpetual bonds into central bank bills, which we've talked about in our write-ups. So the breakdown of China's outstanding bonds in trillions of yuan, 2021 data. So when you look at just almost 120 trillion of yuan, this is, again, the cost continues to go up. We continue to see interest rates bleeding higher. A lot of this debt has to be rolled. It's being rolled at increasing prices, and this is where this pressure, which is why credit impulses are coming down. Like, just roll the debt you currently have. Don't issue new debt. Trying to bring some of this under control, and this is why we continue to be concerned about Chinese growth, Chinese expansion, which in lieu leads to macro growth, global economic expansion, commodity expansion, especially on the oil side. These are some of those overhangs that remain in the market that we talk about in not just the Econ show, but also the EIA show. So if you have any questions, please let us know. We like the back and forth. Again, like, share, subscribe. Your support is appreciated. And I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.